Since the pandemic price lows of March 2020, the following commodities that you see here have more than doubled in price. Items like gasoline, barrels of crude oil, lumber, price of silver, soybean oil, and platinum. Soft commodity prices for basic food staples have also ramped over the last year of time. Soybeans, corn, cotton, sugar, oats, lean hogs, they're all up an average of about 50% over the last year of time. This week, private Federal Reserve Chairman Jerome Powell was again telling the world that these major price escalations are temporary and transitory. Never mind the exploding monetary base nor the increasingly escalating M123 fiat currency supplies in the system. According to Mr. Powell, the increasing prices for important staples will somehow slow and stop soon, although there was no actual explanation in terms this week of how that's going to occur. Billionaire silver bullion bull Scott Minerd, a New York Federal Reserve Investor Advisor Committee on Financial Market member, had the following to say about Jerome Powell's temporary inflation take. He wrote, "It will be virtually impossible for Powell to walk this position back if inflation were to spike for an extended period. He definitely put a stake in the ground." Scott Minerd has also recently argued that the spiking of late U.S. 10-year yield is eventually going to have to give and fall back towards zero and likely negative in real rate terms. The Federal Reserve's balance sheet is almost $7.7 trillion now. And I ran a quick Twitter poll with many of you out there responding, asking the question, how long until this Federal Reserve balance sheet hits 10 trillion? Vast majority of those of you who answered said by the end of this year. Remember, on this channel, we have heard brief clips from macro financial experts such as Felix Zulauf, a man who says that the private Federal Reserve will likely have to fully monetize U.S. government debt, buying all newly issued debts as the end of the decade progresses onward. He estimates that the Fed's balance sheet will have to go to 40 or 50 trillion before the year 2030. It's doubtful how much longer the current divergence on this chart can last. This chart measures the Federal Reserve's expanding balance sheet, the red line, and in the yellow line you can obviously see the ongoing spot price for gold. If we see the balance sheet of the Federal Reserve ramp to 10 trillion by the end of this year, one would expect we would also see new record nominal price highs for gold and potentially silver, as it likely runs into and through the 30s and into the 40s per troy ounce. Now, many retail silver bullion products have already reached those price levels year to date. And thus far in 2021, the investment demand chasing silver has been well higher than last year's 2020, which was unprecedented. And this week, we saw a bunch of allegations and a confluence of reports all around the internet citing issues in the global silver bullion investment markets. So we're going to take a look briefly at some of those allegations this week. Hello, this is James Anderson on behalf of SDBullion.com. Do me a favor, smash the like button below. Doing this is going to help other like-minded bullion-interested viewers to see this information too. Silver and gold spot prices traded slightly up for the week, respectively. The gold-silver ratio stayed at the 66 level, which we closed at last week. A quick look at the major silver ETF and COMEX in and out outflows of late. While investment demand has slowed certainly from the historic rate of last month, February, we can see here that the Sprott PSLV still has many metric tons inbound on a month-long measurement on the far right there, the 4-week that you can see. Also, underperforming non-deliverable to retail shareholding SLV continues to see large outflows of silver. Perhaps the trust's APs are converting shares for physical bullion needed elsewhere around the world. We can also surmise that there has been a large silver sucking sound coming from the COMEX, just looking at these numbers. If you have a look at this chart, you can see that the COMEX enjoyed a large inflow of London 1,000-ounce silver bars during the 2020 high premium arbitrage situation last year, where there was a dislocation between the futures price and the spot price. But the start of 2021, now we've seen nearly 30 million ounces of silver that has been fully withdrawn from the underlying fractional reserve silver warehouses of the COMEX. And the largest outflow of silver from the COMEX silver warehouses and the timing of this Q1 2021 basically tells me that the demand has been investment silver bullion driven, not industrial, at least not yet. This week there was a rash of allegations aimed at sovereign mints, who are apparently falling short in the eyes of many of their customer bases. This article is out of the UK. The reports are that the Royal Mint is struggling to keep up with unprecedented demand. The article link I'll leave in the show notes if you want to go read. In my correspondence with some of you out there online, I was getting first-hand accounts and screenshots of employees who work within the Royal Mint who state the obvious. Basically, they're stating that silver demand is from around the world and it has been hitting them at record levels. This screenshot made the rounds today. It shows a customer of the retail website of the U.S. Mint, which typically sells collector, modern, numismatic type products at high premiums over spot, basically being told by the U.S. Mint that their order's canceled. Reportedly, the largest silver producing nation in the EU, Poland, is now out of investment grade silver to sell to investors via this website screenshot. And on the other side of the world, down under in Australia, many unallocated Perth Mint clients are looking to convert their loans into bullion are having real trouble getting silver bullion from the Perth Mint. They're often being told that they cannot convert currently and or that it will take months before possibly getting silver bullion from their unsecured loans, but they're being offered to add their name on a waiting list. So there's that. Our SD Bullion CEO had the following silver supply demand related industry news today. I think you'll find it insightful and interesting. Tyler here is speaking to the TF Metals Report website. As many of you are aware, SD Bullion mints a number of our bullion products through Sunshine Mint. The Sunshine Mint is also the largest blank supplier to the U.S. Mint for Silver Eagle production. Furthermore, the Sunshine Mint is contracted by many national governments to produce their sovereign mint coins. Unfortunately, we received news today that Sunshine Mint is unable to accept any new production contract orders until at least September 2021. They are in the process of relocating their minting operation from Coeur d'Alene, Idaho to Las Vegas, Nevada. Due to COVID and other unforeseen events, the multi-year planned relocation is not going as smoothly as hoped. Unfortunately, this is obviously not good news on the physical retail front. The U.S. Mint and their planned stoppage to switch the dies from Design 1 to Design 2 was already going to test a market with well above normal demand. This event is likely to have reaching implications on other retail-friendly coins and bars. As it relates to your questions on unallocated metal, I know your community well, and I do not think many of your readers will be that surprised. Unallocated metal is used as a financing tool by many mints and competitors in our industry. Its attraction is offering a very low-cost way to freely transact unallocated metal. However, the strains of the industry right now on the production side, aligned with strong demand, are slowing down the ability to deliver on many marketing promises they have made. There's a reason why the old phrase, if you don't hold it, you don't own it, is passed around the TFMR community. I also wanted to provide some insight to your readers on hedging. I've been asked this question numerous times in the past on how dealers hedge their inventory. There are a few different strategies. However, the majority of bullion dealers I've talked to short all their inventory to hedge their net asset value in USD. When we started SD Bullion, we chose not to take on that hedging strategy as we felt like we would be actively participating in the suppression of futures prices. What we do is maintain the majority of our net asset value in gold, silver, platinum ounces. In other words, we have a target ounce position of all metal types that does not move based on whatever we can afford, while leaving a portion of USD for financing accounts, receivables, payrolls, etc. When we make profits, we will reinvest as much as possible into increasing our targeting position. If it goes below that target position, customers make purchases from us, etc., we purchase metal to get back to our target position. If we go above that target position, buybacks or sourcing large amounts of inventory from mints, etc., this is the only time we'll short a contract to get back to our target position. We've done this from day one of SD Bullion history. Just an aside, the company began in 2012. How many farmers do you know who are hedging their land value for USD? However, in the precious metals industry, we are one of the very few who approaches precious metals like this. During times of record demand, a number of our competitors, mint suppliers, are sourcing even more inventory and shorting even more in the futures market. Furthermore, the mint refiner supplier they purchase from shorts the metal. In fact, a number of our suppliers have to increase the amount of debt they have just to finance their short hedge contracts during times of recent demand. They are paying interest, which is going up, to the banks to short the metal. Inevitably, it's a cascade event that basically goes all the way around to the miner. Unfortunately, unlike SD Bullion, which maintains zero debt, many of our suppliers and competitors are leveraged with debt. And quite a few of these businesses are run by individuals who do not understand precious metals and the purpose they serve. Banks who they have loans from may dictate them to maintain a certain USD net asset value, but unlike farmers who understand land values, they do not understand the history of precious metals. They view holding any portion of their net assets in precious metals as risky, even when the value of the USD has depreciated over 95% over the last century against an ounce of gold. Thank you all for a great community at TFMR. I enjoy participating behind the paywall to avoid the trolls pushing their agenda. I wish everyone a great weekend. Dr. Tyler Wall, President and CEO, SD Bullion. This little illustration I used a few years back needs a gentle update right now. There. Now, in a real physical silver squeeze, which leads to a physical gold bullion squeeze, essentially a bullion bank run, many of the weakest derivatives and market participating product offerings are going to have increasing trouble, and some of them will probably fail. The allegations that we covered and the industry issues that we're seeing now, it's not surprising. My hunch in the years that are coming, many of the wrong choices people made are going to be costly, as they're going to be left out, poorly positioned, while bullion values potentially move exponentially higher. Don't choose the underperforming, inferior products. Get your bullion position secured while you still can. That's all for this week. Take great care of yourselves and those you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.